For tuning into Talking Point. I'm your host, Neeraj Shah. There's a bit of a flavor or green color to the markets today. Remember, I spoke about this. Some of the Asia strategists too have turned positive at the margin on India on relatively better valuations, if you will, and resilient economy. But an interesting note put up by ICICI Securities suggests that sustainable growth continues to be expensive despite the correction, and that growth at reasonable price stocks, or GAR as it's known, stocks, are largely emanating from cyclical sectors. My question to Vinod Karki, the author of that note, is whether his optimism therefore is shifted to the cyclical space, or does he still remain constructive on some of the other pockets as well? Remember, his base case was back in 2022 that at some point of time in 2023, we'll have rate cuts coming in. SVB or maybe something else has only added credence to that thesis. Vinod, great having you. Thanks for joining in OPAL as well. Um, Before I come to the note, Vinod, can I quickly just get a very quick synopsis or quick idea about whether you still believe that that rates will come off in the second half, and if that leads to risk assets looking more attractive?
Yeah, hi Neeraj. Thanks for having me. I still believe that's the base case scenario. Simply because if you look at the way commodity prices have been behaving, and the way some of in the US X commodity you have shelter cost, and now so the core component of inflation where it's shelter services and which is driven by wages. So you're seeing some softening in wages also, and the job market is also a little uncertain. So I think the drivers for inflation, be it commodities, wages, house prices, rents, all are trending down. One can only argue that it may take some time for it to really slip below, to the comfort zone. But the trend is absolutely clear in everyone's mind. So I think the base case scenario still remains. Only it's a timing issue that, okay, you think 6 months, someone thinks 9 months ahead. It's the trend line is clear that on the rate of the Fed's rate projections or the inflation trajectory as of now, unless something goes haywire. Basically.
As of now, that's such an important three words to add in the current scenario, I tell you.
Yeah.
Okay, so I looked at your strategy note with interest. What is the implication? Is the implication, or is the inference rather, that the pond to fish in is the cyclical pond, or are you also quote unquote buying into some of the expensive stocks as well, simply because the growth seems to be more predictable out there?
Yeah. So if you look at it carefully, what we observe is that the so-called low volatility and which have growth and quality stocks, they continue to be expensive despite the correction that we have in terms of if you see the optimism in those stock prices, right? But what you also observe is that they may be stagnating or corrected a bit, but what has moved into that club is your cyclical stock. So some of the capital goods engineering companies have started to creep into the growth and expensive club. So this usually happens when the texture of the economy and the market is changing. So we have been highlighting for the last couple of years that it's the investment cycle, and now which will be followed by the credit cycle, which is driving demand in the economy. If you see the aggregate GDP also, if you slice and dice it, it was the gross fixed capital formation which supported that 4.4% GDP growth that we saw print last time, while the private final consumption expenditure was only about 2%, right? So it's amply clear. And if you look at the credit growth, it's in the robust mid-teens that's trending for some time now. If you look at the real estate cycle, every month we see new, it's sustaining quite a bit, basically, in terms of the registrations. We see a pan-India basis, or some of the absorption that we have seen in terms of pan-India absorption of real estate. So, So I think and now we are seeing the government spending also picking up, more ordering on defense. So I think the capital side of the economy, the capital intensive side of the economy, doing much better than overall consumption. Although consumption, I think, has a dichotomy to it, because what is a high end consumption? It's houses, it's traveling, it's eating out. All these are doing pretty well. Leisure, entertainment, they are doing pretty well. So, but the mass scale consumption, low end mass scale consumption, that's languishing, and the
Mm.
reasons are pretty obvious actually. Bulk of the mass scale consumption is done by, I mean, if you see the workforce, split it up, almost 88% of the workforce is in the informal segment, which has not seen enough income growth, while inflation has hit them. But the 12-13% of the workforce is in the formal segment, which has got overall wage growth even during COVID, and continues so. I mean, if you look at the expectation of wage growth in the formal segment, it's anywhere between 9-10%. It has been that range,
Sure.
and more people are getting into that club in terms of formalization. So I think there is a clear dichotomy in consumption also, but overall it gets balanced out by the mass scale low end consumption being pretty weak, which is showing up in the aggregate number of private final consumption expenditure.
Got it.
So I think stocks will reflect that. That's what is showing up, that the companies which are catering to the investment cycle, what are those? Those are capital goods, engineering companies, cement, steel, so those kind of things. Although some of these, like steel, for example, gets impacted by global prices, not so much cement. So that remains relatively more sustainable growth compared to steel. So there is an angle to that also. But bulk of it, I mean, is showing up in. So that will reflect obviously in credit growth. So over the last decade or so, what has been really thriving in terms of credit growth is the retail credit, whereas industry credit has been down in the dumps. I mean, it has been decreasing over the last decade, and only in the last year or so we have seen it come back to closer to double digit. So I think it is in the first stage of recovery, the industry credit growth. And if the investment cycle that we are observing continues, then industry growth will be the one which will really drive credit growth, while consumption will maybe sustain, or it will not flare up from where it is right now. So that's the broad thesis.
Okay, interesting. I'm going to ask you 3 follow-ups in this conversation on the answer that you've given. I'll start off with cap goods. Now, proponents say that if you're looking at expensive valuations out there, you are looking at adverse cycle valuations. Good cycle valuations, where the EBITDA will expand very quickly, might make these stocks look cheap. Proponents also say that if you look at the last 10-year averages for companies like ABB, for example, they are virtually at least 60 to 70 times, and therefore, relative to averages, they are not that expensive. The people who are not so confident about this say that there have been many false starts on the private capex, and if private capex does not follow up, then the government capex is not enough to ensure a long thriving cycle for these cap good companies. Now, my question to you is, looking at all of these arguments, what is your principal argument for either buying or not buying into the cap good space as things stand currently?
Yeah. So first of all, on the valuation, so some of these capital goods may have been expensive, but then there was no growth coming in, right? Now growth has started showing up, right? So that's the first point. Second point is, as we all know, currently, if you see, the investment cycle is largely being driven by the government's impetus on spending, but that remains a small part. I mean, if I were to measure, I think it will be around 16-17% of the overall gross fixed capital formation. The lion's share of gross fixed capital formation, by the way, is driven by the real estate investments by household. I mean, it used to be almost 37% of gross fixed capital formation at the peak of the investment cycle in 2012. And from then, because of this deceleration in the real estate cycle, it has reached 25%. The other major components, obviously, is the corporate. So within corporate, if I break it up, the services is not too bad. So what is services? It's basically your IT and telecom capex. Telecom got a little bit of impact over the last few years because of high competition, but I think it's coming out. But IT continues. So within corporate, in fact, services have been pretty good. The share of services in the overall investment has been pretty good, driven by IT and telecom. But within industry, it is where I think the investment demand will pick up, because some of these sectors like steel, cement, I mean, the capacity utilization is already much higher than the average capacity utilization, which is around 74%. It is above 80 for sure. So, and if you are talking about, so it all adds up. No, so if the real estate cycle is going to pick up, then the capacity utilization is going to rise further and reach 100%. And the problem is, for let's say an integrated steel plant, it takes minimum of 4 to 5 years to set it up. So if you hit now, I mean, in a year or so, if you hit 100%, there is no new steel plant is going to come up in the immediate next year after that. So you got to plan that way. And that's how some of these companies have been planning, and they've been announcing some of these. So right now we are seeing an announcement phase of corporate capex from the industry side, and some bit of it percolating in terms of real capex. But what you have to observe is the cycle. Where are we in the cycle? So from a cycle perspective, we feel that the investment cycle has kind of bottomed out and is on the verge of rising. And markets sniff that early. So that's the problem with markets. They sniff it way early and then bid up prices before things happen. And by the time it's announced and things are done, things are really expensive. So,
but could this be a long cycle in that you get the opportunity even now?
Yeah. So that's what I'm saying. So if you see the report also, that's what we have tried to do. So while on the other one hand, we found some companies in the engineering space getting into the high optimism growth club, but there are companies, if you see some of those, which are still in the GARP stage. I mean, the growth is available at reasonable price. So you've got to dig and find those stocks where it is still not become expensive. While the investment cycle theory continues to hold. So we have measured these false rallies, also false beta rallies, false cyclical rallies. Pre-2021, it has never lasted beyond 6 to 7 months.
Mm-hmm.
Right? So for example, if you have the new government coming in announcing recapitalization of PSU banks, or some announcement happens big time, and defense announcements and things like that, and there is some excitement, and if it's not sustainable, the markets have given away those gains, I mean, in a matter of 6-7 months. That's what we have seen. But in the last year or so, this has sustained. I mean, look at L&T, for example, all through like 2022, where if someone was to tell you at the start of 2022 that there will be so much of volatility, starting with the Omicron and the Russia-Ukraine conflict, and then the jumbo rate hikes by the Fed, will a company like L&T, which is in the capital goods, outperform? The answer would have been, no, it won't outperform, but it has, right? So I think a market is showing that it's for real. I mean, that's what the market is indicating. Our understanding of fundamental cycles is suggesting the same. Only time will prove whether these cycles play out. So, if anyone has lived the earlier capex cycle in 2003-4, no matter how much you would have tried, you couldn't have fathomed that there will be a 10x capex cycle over the next 4-5 years. So it's very difficult. Only thing as analysts and investors, what we can find out is where we are in the cycle, and are the conditions ripening for something of that thing to happen. Basically, that's the only thing we can measure. So according to that measurement, we think that it's on the verge of picking up. Market is validating it by not giving up on these companies in extreme volatile situation. Check any time before 2021 when such epic volatility has happened in the capital markets, and how capital goods stocks have performed. They have significantly underperformed.
Sure.
But it's not happening right now.
Yeah, that's true. That's true.
Yeah.
I mean, maybe some of the defense stocks haven't quite gone high, but I mean, today is a case in point wherein the kind of orders that have come in, not just today, but the last 15 days for some of the defense names is quite spectacular. Maybe that gives visibility as well. So, point well taken, Vinod. When I look at the list, and I'll come to the fairest point at the end, but when I look at the list of stocks which fall within the guard framework, and I presume are names that are attractive enough currently because they present both growth and reasonable valuations. There are three auto names there. Now, they've had a mixed 2022. Arguably, the margin picture should look very attractive in 2023 vis-a-vis 2022. But if you calling them cyclicals as well, what is your thesis on where to invest in auto and for how long?
Yeah, so I think cyclically, I mean, over the last year or so, I mean, they have had their fair share of struggles, basically, in terms of chip shortages and other issues, supply constraints, and things like that. And finally, they seem to be coming out of this rut. And what we have tried to measure is, I mean, the growth, has it been fine for some of these stocks so far? Is it expected to be fine going ahead? Does our analyst who covers this stock has a fundamental positive view in terms of a buy rating on the stock, right? And is it reasonably valued? I mean, these are some of the things we have tried to, the factors that we have tried to put in place. So they are ticking on all these factors, right? So I think from that perspective, they look good to us from a GARP strategy perspective. But I mean, auto as a whole, I mean, it has all different levers. I mean, for example, we also like some the capital goods sector. I mean, the capital goods auto company like Ashok Leyland and all. It may have not figured out in this one because of maybe volatility in earnings or things like that. But this was a kind of thematic on sustainable low volatility growth, those kind of things. But yeah, so that's how we look at it. Growth where things are available at reasonable prices.
Okay. Due to paucity of time, my final question. And did I read it correctly that at the margin you could be turning constructive on ferrous, not just this note, but some of the last few notes that I've read? Does it seem to me that you are turning constructive on the ferrous space? You mentioned ferrous stocks in this conversation as well. So why so?
Yeah, so fundamentally it dovetails with our investment cycle from a domestic perspective. Unfortunately, it has the global angle to it, unlike cement and others, basically. So if things turn adverse, which may not, because China is one driver which is very important for ferrous and metals in general, which is opening up. But the point I'm trying to make is in this kind of scenario where we are little hesitant on global stories, basically, where, it is because anything that will happen on the global demand side. And if you have exposure there, it brings in uncertainty in my view, although recent factors like China opening up and our domestic demand being good, and prices, if you see, have kind of stabilized now. So that price still, ferrous prices or metal prices are the key for these stocks, basically. And they seem to be stabilizing. Factors are, the global risk factors are there, but if you look minutely, doesn't seem to, China opening up is positive, but there are so many nuances to it. But what we are confident about is the domestic demand. But the global demand might interfere with the domestic demand for these companies. And that will create a lot of mixed signals for these stocks. That's the problem.
And thanks for laying it out so beautifully. We'll have to call it a day today, Vinod, but thank you. It's a very interesting note and a fairly interesting thesis that you explained. So some food for thought for everybody that you're leaving us with. Thanks for that and have a great weekend.
Thank you, Neeraj. You too have a great weekend.
Thank you. And viewers, thanks for tuning to this edition of The Talking Point.